In this video, we'll look at the four main depreciation methods used in accounting: straight line, reducing balance, units of production, and sum of the year's digits. In this session, we're going to cover depreciation of tangible non-current assets, focusing on the straight line method, which spreads the cost of an asset evenly over its useful life. Businesses buy assets that help them operate for more than 1 year. Over time, tangible fixed assets wear out, become less efficient, or become outdated. Assets lose value and usefulness over time, so the business is effectively using up part of the asset each year. Depreciation is the systematic allocation of the cost of a tangible non-current asset over its useful life. Examples of tangible fixed assets include machinery, equipment, vehicles, furniture, and also buildings. Straight-line depreciation assumes the asset is used evenly each year, so the depreciation charge is the same amount every year. The calculation works like this. We take the asset cost, subtract the residual value, and then divide by the useful life. Let's quickly break down these terms. Cost includes the purchase price, all costs needed to get the asset ready for use. So it might include delivery, installation, or registration costs, anything necessary to make an asset operational. Residual value is what the business expects to recover at the end. Basically, the estimated amount you could sell it for or dispose of it for when it's no longer useful. Useful life is the number of years the business expects to use the asset to generate benefit. So straight line is simple. It uses same amount of depreciation every year. Depreciation is an expense, and it is shown in the profit and loss statement. In the balance sheet, we show the carrying amount of a tangible asset, which is calculated as cost minus accumulated depreciation equals net book value. Accumulated depreciation is the total depreciation charged on the asset to date. It is shown separately so the original cost of the asset remains visible. As a result, the balance sheet shows the asset at cost, accumulated depreciation as a deduction, and the net book value as the final figure. Now let's do a full straight-line depreciation example from start to finish. A business buys machinery for £10,000. Its residual value is £2,000. That's the estimated amount the business expects to get back at the end of the asset's useful life, for example by selling it or trading it in. The useful life is 4 years, meaning the business expects to use it for 4 years to help generate income. Now we calculate the amount we're going to depreciate. Cost £10,000 minus residual value £2,000. £8,000 is the total cost that will spread over its life. Straight-line annual depreciation means the depreciation is the same every year. So we take the depreciable amount £8,000 and divide by 4 years. We will charge £2,000 depreciation every year. In the balance sheet, we keep the asset's cost visible and record depreciation in a separate account called accumulated depreciation. So the balance sheet presentation is cost minus accumulated depreciation equals net book value, NBV. The original purchase cost stays the same. Accumulated depreciation charged builds up each year. Net book value reduces each year. End of year 1. We charge £2,000 depreciation for the year. Accumulated depreciation is £2,000. Net book value equals £10,000 minus £2,000 depreciation. So the balance sheet would show machinery £10,000, less accumulated depreciation £2,000, net book value £8,000. End of year 2. We charge another £2,000 depreciation. Accumulated depreciation equals £2,000 plus £2,000. Net book value is £10,000 minus £4,000 equals £6,000. End of year 3. We charge another £2,000 depreciation. Accumulated depreciation is £6,000. Net book value is £4,000. End of year 4 is final year. We charge the last £2,000 depreciation. Accumulated depreciation is £8,000. Net book value is £2,000. £2,000 equals the residual value. We don't depreciate below residual value. Residual value is what the business expects to sell for. In our second example, we will be using a delivery van. A delivery van is used daily. It helps business generate income over several years. The van doesn't lose all its value immediately, so we spread its cost over its useful life using straight-line depreciation. The van itself costs £28,800, but there are also £1,200 delivery and registration costs. Now, remember what we said earlier. Any cost necessary to get the asset ready for use must be included in the asset's cost. So we add them together. £28,800 plus £1,200. £30,000 is the figure that appears on the balance sheet, and this is the starting point for depreciation. The van will be worth £6,000 at the end of its life. This is important because the business is not using up that £6,000. It will still exist at the end. So, just like in the first example, we do not depreciate the full cost. Cost of the asset minus residual value equals the amount to be depreciated. £24,000 represents the portion of the van that will be used for calculating depreciation over its useful life. The useful life is 6 years. Because this is straight-line depreciation, we divide evenly. £24,000 divided by 6 years equals £4,000 per year. Every single year, the depreciation charge is the same. Each year, the business records £4,000 depreciation expense in the profit and loss account and reduces profit. Accumulated depreciation builds over time. Each year, we simply add another £4,000. This is why the accumulated depreciation figure grows year by year. The net book value tells us what is the asset worth in the accounts at this point in time. We calculate it as cost minus accumulated depreciation. So we see the value falling steadily from year 1 to year 6. That final figure matches the residual value, which confirms our calculations are correct. On the balance sheet, we always show the asset at original cost, accumulated depreciation separately, and net book value. It allows users of the accounts to see what the asset originally cost, how much value has been used, and how much value remains. So this second example reinforces what we learned earlier. Straight-line depreciation is simple, consistent, and predictable. In this session, we're going to cover depreciation of tangible non-current assets, focusing on the reducing balance method. Reducing balance method is used when an asset loses more value in the earlier years and less value as it gets older. So this method does not spread depreciation evenly. The key difference with reducing balance depreciation is what we base the calculation on. Instead of depreciating the original cost, we calculate depreciation using the net book value at the start of each year. The calculation uses a depreciation percentage rate, not a fixed amount. This means the depreciation charge changes every year. More depreciation is charged in the early years and less depreciation is charged in later years. The calculation uses a percentage, not a fixed amount. Residual value is not deducted at the start. With reducing balance, the residual value is something we expect, not something we build into the calculation from day one. Let's now apply this method to an example. Machinery cost is £8,000. Expected life is 4 years. Depreciation rate is 20%. Expected sales proceeds is £3,277. £3,277 is not used in the yearly calculations. It simply tells us what the asset is expected to be worth at the end. We always start with the net book value at the beginning of the year. Year 1. Net book value at start is £8,000. We now apply the depreciation rate. £8,000 times 20% equals £1,600. Because the asset is new, the depreciation charge is relatively high. Then NBV at end of year 1 is £8,000 minus £1,600 equals £6,400. Accumulated depreciation is £1,600. Now let's record this in the accounts. Let's start with the machinery account. You can see £8,000 on the debit side. Now look at the depreciation cost account. Depreciation is a cost of using the machine in year 1, so we debit depreciation cost £1,600. This reduces the profit for year 1. Now look at accumulated depreciation. This account keeps track of total depreciation so far. We credit accumulated depreciation £1,600. This balance will keep increasing every year. On the balance sheet, everything comes together. Machinery is shown at its original cost of £8,000. Accumulated depreciation is £1,600. When we subtract it, the net book value is £6,400. Let's look at Year 2 calculation. This is where reducing balance really starts to show its difference from straight line. We do not go back to the original cost. In Year 2, NBV at start is £6,400. We apply the same percentage again. £6,400 times 20% equals £1,280. Notice how the depreciation charge is already lower than Year 1. Then NBV at end of Year 2 is £5,120. Accumulated depreciation is £2,880. Now let's record this in the accounts. Nothing new happens. We follow exactly the same process. This year, depreciation is £1,280. So in the accounts, depreciation cost is debited £1,280. Accumulated depreciation is credited £1,280. This gets added to last year's depreciation. So accumulated depreciation is now £1,600 from year 1, plus £1,280 from year 2, total £2,880. On the balance sheet, machinery still shows at £8,000. Accumulated depreciation is £2,880. Net book value is now £5,120. Year 3 calculation. The process now repeats exactly the same way. In Year 3, NBV at start is £5,120. Depreciation is calculated £5,120 multiplied by 20% equals £1,024. Each year, the depreciation gets smaller because it is based on a smaller value. Then NBV at end of Year 3 is £4,096. Accumulated depreciation is £3,904. Now we move to Year 3. At this point, you should notice that nothing changes in the method. The depreciation is smaller again. So once again, we debit depreciation cost and credit accumulated depreciation. Accumulated depreciation continues to build up and the net book value continues to fall. Now we are in Year 4, the final year in this example. Exactly the same accounting entries are made. So remember, machinery is always shown at its original cost in the balance sheet. Depreciation goes to profit and loss. Accumulated depreciation builds up each year. The net book value falls over time. Once you understand Year 1, every other year is just the same process repeated. Let's look at the summary tables. The net book value steadily reduces but never reaches zero. This slide now shows a shortcut formula that allows us to find the net book value after a number of years in one calculation. This formula helps us understand what is really happening with reducing balance depreciation. Net book value equals the original cost of the asset multiplied by 1 minus the depreciation rate raised to the power of n, which represents the number of years. Cost is what the asset originally cost. Depreciation rate is the reducing balance percentage. N is number of years the asset has been depreciated. Each year, we are repeatedly reducing the value by the same percentage. Let's apply the formula to our example. In our machinery example, the cost is £8,000 and the depreciation rate is 20%. The asset is depreciated for 4 years. So we substitute into the formula. NBV equals £8,000 multiplied by 1 minus 0.2 raised to the power of 4 because the depreciation is applied for 4 years. Net book value is £3,276.80. This figure matches the net book value we calculated year by year. When rounded to the nearest pound, this becomes £3,277, which is what we used in the accounts. In this lecture, we're going to look at a depreciation approach called the units of production method. Instead of time, depreciation is based on how much the asset is actually used, such as the number of units produced or hours worked. We'll go through the method step by step using a detailed example. Depreciation is linked to output or activity, such as units produced, machine hours worked, and miles driven. If an asset is used more, it depreciates more. This method is appropriate when wear and tear depends on usage and output can be measured reliably. Typical examples are manufacturing machinery, vehicles, equipment charged by operating hours. The first step in the units of production method is to calculate depreciation per unit. To do this, we start by calculating the depreciable amount of the asset, which is the cost of the asset minus its residual value. This represents the total value that will be depreciated over the asset's life. We then divide this depreciable amount by the total expected units of production over the asset's useful life. This gives us depreciation per unit. In other words, it tells us how much of the asset's cost is used up each time one unit is produced, or each hour the machine is used. This gives us a fixed cost per unit, not a fixed cost per year. Finally, we multiply depreciation per unit by the number of units used in the year to calculate annual depreciation. Let's now look at a full-worked example of the units of production method so you can see how the calculations work in practice and how depreciation appears in the accounts. An airline purchases a plane for £120,000. The plane is expected to have a residual value of £20,000 at the end of its useful life. The plane is expected to be used for 16,000 flight hours in total. Flight hours measure how much the plane is actually used. First, we calculate the depreciable amount. This is the part of the asset's cost that will be written off as depreciation. £120,000 minus £20,000 equals £100,000. So, £100,000 will be depreciated over the plane's life. Next, we calculate depreciation per flight hour by dividing the depreciable amount by the total expected flight hours. £100,000 divided by 16,000 flight hours equals £6.25 per flight hour. Every hour the plane flies uses up £6.25 of the plane's value. In year 1, the plane flies 4,000 hours, so depreciation is £25,000. In year 2, usage increases to 4,200 hours, giving depreciation of £26,250. In years 3, the plane flies 4,000 hours, so depreciation is £25,000 per year. And in year 4, usage decreases to 3,800 hours, giving depreciation £23,750. Over the 4 years, total flight hours equals 16,000, and total depreciation equals £100,000, which matches the depreciable amount. This confirms the calculation is correct. This table shows how depreciation appears in the profit and loss account each year. Depreciation is treated as an expense, so it reduces profit in the year it is charged. This table shows accumulated depreciation, which appears on the balance sheet. Accumulated depreciation is the total depreciation charged from purchase up to that date. At the end of year 1, accumulated depreciation is £25,000. By the end of year 2, it increases to £51,250. At the end of year 3, it becomes £76,250. And by the end of year 4, accumulated depreciation equals £100,000. This total matches the depreciable amount, meaning the asset has been fully depreciated down to its residual value. Net book value represents the carrying value of the asset on the balance sheet. It is calculated as cost minus accumulated depreciation. At the start, in year 0, the plane is shown at its full cost of £120,000. At the end of year 1, the net book value falls to £95,000. At the end of year 2, it reduces further to £68,750. At the end of year 3, it becomes £43,750. And at the end of year 4, the net book value is £20,000, which equals the residual value. This shows that depreciation has fully allocated the depreciable amount, and the asset is now carried at its residual value, so no further depreciation will be charged beyond this point. This slide brings everything together in year 4. On the profit and loss account, depreciation expense for year 4 is £23,750. This reflects the actual usage of the plane during the year 4. The plane remains recorded at its original cost of £120,000 on the balance sheet. Accumulated depreciation is now £100,000. On the balance sheet, the aircraft is still shown at its original cost of £120,000 because assets are always recorded at historical cost. From this, we deduct accumulated depreciation, which by the end of year 4 totals £100,000. This gives a net book value of £20,000, which represents the asset's carrying amount on the balance sheet at that date. This £20,000 is the net asset value of the aircraft. It reflects the portion of the asset's economic benefits that have not yet been consumed and is equal to the expected residual value. This method is suitable where the pattern of consumption of an asset's economic benefits is best reflected by units of activity rather than a time-based measure. In this session, we are going to look at another method of depreciation known as the sum of the year's digits method. This method is used when an asset provides more economic benefit in the earlier years of its useful life and less benefit in the later years. Because of this, the depreciation charge is higher at the beginning and reduces over time. For this reason, the sum of the year's digits method is described as an accelerated depreciation method. Assets commonly depreciated using sum of the year's digits are machinery and equipment, vehicles, technology and plant that become less efficient over time. When an asset is new, it is usually more efficient, experiences fewer breakdowns, and generates higher output. Let's now see how this depreciation method works in practice using a full numerical example. A company buys a machine for £12,000. It is expected to be used for 4 years, and at the end of its life, its residual value should be £2,000. So straight away, we identify the amount that will actually be depreciated. We do not depreciate the full cost. We only depreciate the part that will be consumed over time. The depreciable amount is the cost minus the residual value. £12,000 minus £2,000 gives us £10,000. This £10,000 is the total expense that will be spread over the 4 years. Now, instead of spreading it evenly, this method recognises that assets usually provide more benefit in earlier years. So we use a sum of years digits. When we use the sum of years digits method, the numbers 4, 3, 2, 1 simply represent the remaining useful life of the asset at the start of each year. We add those numbers together to create a total weighting base. This total of 10 becomes the denominator in all our depreciation fractions. Now we allocate the £10,000 using those fractions. In year 1, the asset has 4 years of life remaining, so we take 4 over 10 of the depreciable amount. 4 over 10 of £10,000 equals £4,000. In year 2, there are 3 years remaining, so we use 3 over 10. That gives depreciation of £3,000. In year 3, we apply 2 over 10, which is £2,000. And finally, in year 4, only 1 year remains, so 1 over 10, which equals £1,000. Notice the pattern. Depreciation is highest at the start and reduces each year. Let's now look at how depreciation flows through the financial statements over time. Starting at the top, this table shows depreciation in the profit and loss account. There is no depreciation in year 0 because the asset has just been purchased. Then, using the sum of years digits method, year 1 shows a depreciation charge of £4,000, year 2 shows £3,000 and so on. Each year, only that year's figure appears as an expense in profit or loss. Accumulated depreciation is the running total of all depreciation charged so far. So, after year 1, accumulated depreciation is £4,000. After year 2, it increases to £7,000. After year 3, it becomes £9,000. And by the end of year 4, it reaches £10,000. This figure always increases and never goes back down. Finally, the bottom table shows the net book value of the machine on the balance sheet. Net book value is calculated as cost minus accumulated depreciation. The machine starts at £12,000 in year 0. As depreciation accumulates, the net book value reduces £8,000 after year 1, £5,000 after year 2, £3,000 after year 3, and finally £2,000 after year 4. That final figure equals the residual value, which confirms that the asset has been depreciated correctly. Depreciation hits the profit and loss each year, builds up in accumulated depreciation, and gradually reduces the net book value on the balance sheet. Let's look at how we recognize the depreciation charge for the year and update the accounts accordingly in year 4. First, in the profit and loss account, we record the year 4 depreciation expense of £1,000. This is shown as a debit to depreciation cost because depreciation is an expense that reduces profit for the year. At the same time, we credit accumulated depreciation by £1,000. This increases the total depreciation charged against the machine over its life. Looking at the accumulated depreciation account, you can see depreciation from all 4 years added together. This gives total accumulated depreciation of £10,000 by the end of year 4. On the balance sheet, the machine is still shown at its original cost of £12,000. Below that, we deduct the accumulated depreciation of £10,000, which leaves a net book value of £2,000. In summary, depreciation is charged to profit or loss each year, accumulated depreciation is updated accordingly, and the asset continues to be shown at cost less accumulated depreciation.